This is the Texas Land Guys podcast, hosted by brothers Tim Dosch and Tom Dosch. With their partners David Marshall and Tripp Rich, they have built DMRE, the leading land brokerage in Texas. With decades of experience brokering deals between landowners and real estate developers, they take you inside the deals that move the market.
Okay, well, on the podcast today, I'm sitting here in Dallas with Tripp Rich from our Austin office. Got Tim in our Houston office, and we're going to be talking about kind of a wrap-up of quarter two activity across our markets in Texas. And so, guys, welcome to the podcast.
Good to be here.
Good to be here, man. Thanks for having us.
So it's interesting. We were talking about just how things were looking 90 days ago going into Q2, and I don't know that we saw some of the kind of big macro impact that would come down the pipeline, and just that we would see start to impact some of our deals, and not necessarily our deals as much as just the market in general and maybe perception of the market. So Tim, I'll start with you. Like, what are some of the things that you think we've seen that have just kind of made Q2 feel a lot different than Q1?
Yeah, it's definitely different. I mean, I remember when we were doing this podcast in Q1, just kind of talking about the year and all the excitement for the year. There was a lot of energy and momentum in the market. Everybody was when you go do deals, and it felt like kind of across the different use types, things are really positive. And, I feel like things really started to shift with Liberation Day and all the tariffs and all that talk. And, I don't know that that's like really in itself, like the cause of the market struggles. It's definitely been a big news story. At the time of this recording, there's also the Israel-Iran conflict that's going on, which, may or may not be that big of a deal from a, market standpoint that affects us. But there have been some geopolitical issues. There's these, tariff issues going on. There are some headwinds just in the market from a national economy standpoint. Potential recession or 2 quarters of negative growth. I don't feel like it's a significant recession, but consumers seem to be pulling back. We're hearing that home sales are sluggish with a lot on the single family side, that builders are having a hard time moving product. And then there's challenges in some of the markets with supply in certain areas on the multifamily side and the industrial side. So there's definitely issues, but at the same time, coming into Q2, we were able to close a good number of deals in Q1, and we closed more deals in Q2 than we did in Q1. And then we're still set, I think, to have a really good Q3 and Q4. There's a really good pipeline across the state of deals that we feel good about, despite some of these market challenges we're talking about.
Yeah, it's a good point, Tim. Looking at just the numbers, we had, I think, about 50% more closings in Q2 than in Q1, which is great. I mean, that for us, it's, the activity that we work on of making offers and putting deals under contract is great. But at the end of the day, it's more about what actually closes and gets across the finish line. Tripp, I mean, when you're thinking about where you were sitting at the beginning of this quarter and just where we ended up, I mean, what are some of the things that you think made Q2 just feel a little bit different than Q1?
Yeah, Austin was pretty interesting. We've started to see multifamily developers come back into the marketplace and really start to hunt for deals again and make offers again. Some of our best clients hadn't made offers in some of them over 2 years.
Wow. And
when those groups started to come back to make offers, that was pretty exciting, to put it lightly. And so, that was a big fundamental shift for us. We started to bring out some more multifamily listings. We saw some more multifamily sites become available. Still don't know if it's the best time, but it's an interesting time in the marketplace where some groups have to get out that have just held this land for too long. And then on the contrary, a lot of these bigger groups that had massive pipelines have now dwindled out. They don't have any more development fees coming in. And so while the market's not ideal today, looking out into the future, into 28 and 29, there's not going to be any supply. So I think it's an incredible time to do it. But that was the biggest shift we saw on the multifamily front, was a lot of groups that hadn't done anything in the past 18, 24 months start to make offers again.
Yeah, it's interesting. I think with just the single family builders starting to slow down a little bit, we saw that happen in Q2 from where we were. Because to start the year off, I mean, there was a lot of activity on the single family side. We knew that there had been a ton of deliveries. And so at some point when you have so many deliveries, there's going to be somewhat of a pause. But that was a big adjustment in Q2. I think starting Q2, probably started seeing that like a couple weeks into the quarter. And then we've continued to see a shift around that. You mentioned that, Tim, just builders either needing land bankers, lot bankers needing more time on deals, or, wanting to, like in the DFW market, maybe just diversify if they had big lot positions, wanting to trade out some of those positions with different builders. And so definitely seeing some changes around that. And then on the multifamily side, I think just time. It's like going into the year, there was so much positivity, but then because Q2 had some of these big macro things that happened, you've just seen developers needing more time. It's almost kind of like Q2, that whole 90 days now we're seeing on the back end where developers are going to need that type of time added back to their deals if they were early in on their deals, for those deals to make sense.
Yeah, and it's really an equity issue. I think equity was a lot more bullish in Q1, and then I think when some of these tariff issues and bigger market issues came out, equity's gone back to the sidelines or just gotten super careful. And so we're seeing that on the sponsor side that they're only willing to work with certain developers, at least on the Houston deals we're pursuing. There's some developers who are getting institutional capital looking at their deals. And then there's other developers that are good developers we've done a lot with in the past that are having to drop deals because they just can't get any equity at all. So I think that's been one of the big shifts on the multifamily side in the last 60 days or so.
One of the things we talked about in our Q1 summary was just we had a lot of large acreage sites under contract that were scheduled to close in Q2. I think all three of our offices actually did see deals close. We saw some push out that'll close hopefully Q3, but we did see thousands of acres close across each of our offices in Q2. So that was really encouraging because those are huge investments. They're long-term investments, some really large just land takedowns and some deals that, in some cases they came together really quickly because there was just opportunity. In other cases, it was developers have been working on these deals for years just to get entitlements on water and utilities. And Tim, I know in Houston, that was definitely the case. You guys closed a couple really large deals and there was a lot of work over a couple year period that had gone into just those deals happening.
Yeah, and we felt a lot of confidence that they would happen because, the developers had millions of dollars hard and a lot of pursuit costs, and they've just been held up by local municipalities and some site development issues that they were working through and had to get those figured out before they could close. But we're still pretty bullish on those deals here in Houston. I'd be interested to hear what you guys are seeing in Central Texas and Dallas, but there's a number of large deals we have under contract that I feel really good about happening. And it's still, from a Houston standpoint for our office here, historically, we've never done this many, large acreage, 1,000+ acre kind of deals all at the same time. And so that market seems pretty solid still, just because they're looking out longer term and they're not as concerned about what's happening right now. I think where we're seeing the challenge is just on the kind of the smaller stuff, that's more where the builders are ready to go do it right now. That seems to be pulling back a little bit.
Yeah, we've definitely seen that in DFW. The townhome deals have become much more challenging. Depending on location, there's still some locations where it makes sense, but there's a lot of these municipalities further out that'll zone sites for townhomes, and you're out in the suburbs, and it's a much more difficult site for a builder to build, just from a cost standpoint, but also just the market for people that want to go buy townhomes way out in the suburbs. I think it's not really as strong of a market in Texas, unless it's a really unique setting. And so there's a lot of those sites that builders were pursuing that we saw a pretty significant pullback on a lot of those opportunities in Q2. And, before that, it was like if you had finished lots, it didn't really matter what it was. If it was townhome, attached or detached. At first, it was the builders pulling back on, it was the attached townhomes, but then it was them even pulling back on the detached townhomes. And so that was a big adjustment. Tripp, are you seeing these large acreage deals happening in Austin too right now? Just knowing you guys have had a lot of deliveries, but those are longer term investments.
Yeah, I mean, we just had one close, I think, last week, which was really exciting. And there's been a couple of groups, including that one, that still want those really big takedowns. But outside of, the few unicorns right now, most of the single family guys, I would say, pulled back. We saw a lot of pullback in Q2. That was something we definitely noticed as well. And I think that was like tariffs and then the 10-year growing in the wrong direction in a supply scenario. And then you start to see some of these communities in certain pockets not perform so well. So it's probably a little bit of, market and location driven. But yeah, it's interesting. Most of the builders right now that I'm talking to really want like finished lots they can go put in production now and make money now instead of a long drawn out period. They don't want the land on their books. They don't want the risk. Still seeing a lot of land banking going on. But for the most part, the single family guys are getting they're very picky right now. And I think the tariffs kind of shook them up a good bit.
What do you think the the demand is right now for these larger deals, knowing that like in Austin, there's probably only so many places you can really go.
So it's interesting because I probably have a different viewpoint, but there's not really, you don't have the master plans in Austin area like you do in, I would argue, in Houston and Dallas. So I think, right now there's maybe 3 master plans that if like true massive master plans that have ever been done in Austin, and they're typically 7 to 10 year deals. And so I think long term they do really well. I think it's all about buying it right and having a plan. So I don't know. Time will tell for sure, but I think it's going to end up working out pretty well for the master plan communities, because there's not really anything like that. Most of these smaller projects that these builders go and develop for starter homes, it might be like 100 or 150 acres, kind of out in the field. There's not really any big amenity or draw. It's like you might have decent schools, but it's really hard to develop in north and west and southwest Austin, where all the good schools are. So I don't know. It's time will tell.
And Tim, a lot of the development in Houston on those larger acreage deals, especially what we saw close, I guess in Q2, those are obviously pretty far out, because when you're talking about 1,000 acres, it's pretty amazing just how far out that development is going. Is there a certain part of town that you feel like, or a couple parts of town where there's a big focus on doing those and just kind of showing like, here's the direction that we think Houston will be growing for the next 10 to 15 years?
Yeah, I mean, the ones that have closed have actually been Southeast Houston around League City, which is somewhat close in relative to the other areas. So, New Ground Parkway area in Southeast Houston, we have a couple thousand acres down there, and, with different buyers, buying those. Where we're seeing a lot of the growth is going northwest and north. And so New Waverly, which is north of Willis, which is north of Conroe, is getting pretty far up there. Everything basically past Magnolia and Montgomery County. So getting, really far out. I mean, we're almost going, towards Navasota and College Station, starting to grow out that direction. And then I think Waller has been the biggest growth corridor going out 290. There's just been really strong growth out that way, thousands of acres being put under contract, going all the way out to Hempstead. So that's been a really good growth area. On the west side of town, in the southwest side of town, development's gone so far out already. I mean, you're looking at Sealy and past Sealy, that it's getting really far out, and then Richmond Rosenberg. So I think the main growth area is kind of northwest right now.
Yeah, it sounds like if development's gone that far out west, it almost has to start filling in some of these other areas first.
Yeah,
unless
right.
There's significant job corridors developing out there too, because people will only be able to commute so far.
Yeah, I mean, there's a lot of industrial growth. Katy is a major, population center, and there's a lot of hospitals out there and jobs. But I think you're right. I think that it makes sense that we're seeing things fill in more off 290, because that's just a little bit closer in than going out to Sealy.
Well, and I know the tariffs, we mentioned tariffs earlier. It's unknown right now exactly what that impact will be. I think there was a lot of surprise, because we talked a little bit about that on the podcast before. There could be tariffs. Trump had talked about tariffs. And we kind of wondered, is that negotiating? Is that really going to happen? What's the response going to be? We still don't really know. And to your point, Tim, some of it could be a little bit of just something to fall back on as like a reason or an excuse. It definitely has an impact, and we'll see what the impact really is. But what we've heard is on the single family side, it's a pretty marginal impact, the cost that it's really adding to these deals. And I've heard something very similar on the multifamily and the industrial side too. And part of that could be because you already had prices kind of coming down in some use types. Like I've heard Houston is probably the most affordable place to develop right now in Texas. But Dallas, we've had pricing come down pretty significantly in some cases. I mean, we've heard anywhere from 10 to 15% on some multifamily projects, and it's just a function of big work base, and they're not as busy as they were, and they're willing to go and work and take some lower rates to do it. And then, some of the hard costs have come down as well pretty significantly. So that's a big positive just for deals happening in our markets. Obviously, if we really see activity pick back up, costs will also creep back up. But it's a very unique time that you're actually seeing costs come down, because since I've been in the business, costs have really only ever gone up. And what it cost to build, 10, 15 years ago, you just only dream about being able to develop something for now. So this is a pretty unique time. And we do have and see clients taking advantage of that right now, just the ability to go build at a lower cost. That's the type of deal that these big institutions want to be a part of. And so I think that we're definitely seeing that happen.
Yeah, I would say that the tariff issue is really more psychological from an impact standpoint than actually like a real impact right now. I mean, I think there's a lot of uncertainty that people are worried about it and what could happen. And that the main place that's really hit, I think, is the equity side, and maybe the public home builders are just being more conservative and kind of taking a step back and more of a wait and see approach. But if you look at, are there actually, these big increases in pricing, to develop, or are there supply chain issues, or that, those kind of things haven't really materialized yet. And so I think the real impact has not been that big, but, unfortunately in our business, I think sometimes 90% of it is actually what people's uncertainty and confidence and more the psychological side of things that the people enter the market with has a bigger impact.
Well, it's interesting that we've seen a lot of industrial activity in DFW, probably the strongest use type for us right now, just the most consistent that we've seen in Q2. A lot of developers have sites that they've put under contract, have been able to get projects zoned, have been able to get projects closed. And that's been refreshing because we'd really been working in just like a very tight geographic area for the last 2 years. And that's really broadened right now. And so Dallas, I think, is pretty well positioned on the industrial side. We really expect that to continue into Q3. But that, I would say, single family was probably the most impacted in DFW and in Q2, followed by multifamily. And then industrial really hasn't missed a beat from what we've seen. It's stayed very active, and we've had a lot of good traction on different deals with clients, several closings on some complicated sites too, where developers have solved some complicated issues, found equity, and are getting out of the ground.
Yeah, Houston, I think industrial, might be our strongest use right now as well. We're starting to see them get into the low teens from a pricing standpoint on some sites, which is a really big move for us, and seeing some big deals go under contract and actually close. We're also seeing the fundamentals stay really strong here. And the Q2 fundamentals for industrial, a lot of people believe are going to bring even more developers to the Houston market. So I think there's some good momentum on that side. And then on the multifamily side, we've actually seen some really strong numbers on some infill suburban dirt this year, kind of surprising numbers. There's been a couple developers who have capital who are taking advantage of really good sites coming to market that are probably higher priced sites than we've seen in those suburban submarkets, but they're just really quality sites with good fundamentals around them, high barriers to entry, and they're paying up for those sites. And we have a lot of confidence that they're going to get done. So that's been kind of the bright spot on the multifamily side. And then from a more negative standpoint, we're just seeing a lot of kind of the middle of the pack developers on the multifamily side just struggle to get anything done. Tie stuff up, drop it, make offers that are very weak with tons of timing, like 400-day kind of timing to close, which in Houston we never see that. But there's just not a lot of confidence that they can get deals capitalized.
Tripp, at the beginning of the year, you mentioned that you expected multifamily activity to start to pick back up at some point this year in Austin. And obviously, it really hadn't at the beginning of the year. We were talking about in Dallas and Houston, with the new administration and all the excitement and positivity, we were starting to see offers. There was a lot of momentum. But then you just made the comment that you guys really did see that start to happen at the beginning of Q2. So what do you think it was? I mean, was it just a delay in time from just you guys are a little bit behind these other markets because of the supply and you've had good absorption numbers? Like, what do you think has gotten these developers active again? Sure.
Yeah, I think it's been a combination of supply absorption in 2024 and then leasing velocity really picking up helped a ton. And now that we're projected to get another 25,000 units absorbed this year, which would be another record-breaking year consecutively in Austin. And then in Q4 of 24, we had 0 starts.
Yeah, that's incredible.
That's the first quarter that's ever happened since they've ever been tracking that for
how
long that's been. So I think it's a combination of those two things mixed with some equity partners starting to quietly put some term sheets out there, and the word gets around kind of fast. And so, lastly, on top of all of that, a lot of these developers that are starting to be active again know that Austin will come back. And they believe in it long term. And, there's reason that they are local to it and build there and want to remain there long term. So combination of all those, I think.
Are you hearing about construction price saving in Austin? It's normally more expensive to develop there than these other markets.
Yeah, so it's more expensive to build in Austin than Dallas and Houston. Dallas is probably next, and I think Houston's the lowest. But, we've even seen a trend where, during a lot of these downtimes, and even this year, there's developers that are in Austin that are now going to build in Dallas and Houston, and specifically Houston because of how cheap it is to build there and how easy it is to build there.
Yeah,
it's pretty wild.
That's really interesting. Yeah,
but I have seen, I would say it's like 12 to 14%.
Wow.
Come down on pricing.
And that's huge. I mean, if you're talking about, pick a number, $70 million project, the average apartment deal these days is probably easily 70 to 80 million, just with how it could be more depending on the size of the, unit count. But you're talking about 10, 15 million in savings depending on the size of the project. That's significant.
And it definitely depends on the deal for sure. Most of this is on garden product, which is what we're seeing most people do right now. But yeah, it's great. We need it to come down a lot more.
Yeah.
But I'll take it for sure.
I mean, you're talking about really the value of the land is what that's equivalent to.
Yeah.
When you talk about that big of a percentage, and it probably makes sense why we're seeing some of these deals. People get so aggressive in Houston on some of the really good sites because they're thinking if we can save on construction costs and get a really good site, we can go pay $5 more a foot than maybe we would have before.
Yeah, we closed a deal in May, so a Q2 deal on the multifamily side, and as we were under contract, they had rebid the project and savings were about 10%, and this is a roughly $80 million project, and then by the time they closed on the land, it was another 10 to 12% off of that, and it ended up being probably like a 15% savings, and so to your point, Tim, it was actually like 1.5 times the value of the land is what they saved just from where it was, 15 months before. And so we've heard that a couple other times, some deals we're invested in where there's just been some big savings if you can break ground right now. So we've seen in Dallas, we had some pretty interesting deals close in Q2. We closed a high-rise site really recently, a couple weeks ago in downtown Dallas. We closed a wrap project that's out off 114 in the Roanoke market, really high barriers to entry, really unique site that closed. Another garden project close by that one, where Carlisle was actually the equity, which was really interesting because we've seen them be really active, continue to be really active. And then that other project I mentioned down in kind of the South Fort Worth market that had all the cost savings. So, I mean, we've closed now almost, I think, 10 ground up multifamily land sites this year in DFW, and no deal's easy right now. Every deal has to have a story, and the story either has to be like high barrier to entry market, really low cost, or it has to be that it's just a really incredible kind of irreplaceable site. And so, I tell people that it's not an easy job to find those sites, but that's our job to do it. And so we find the deals that make sense. And, we're hoping that by the end of the year, we'll have closed something like probably 30 to 40 multifamily land sites in DFW, just as what we have in the pipeline. So it's still a very, very active market.
Yeah, that's incredible. I mean, if that happens, and, I think there's a chance in all three of our markets that we could have our best year ever or close to our best year ever, but, in each market and as a company, which is pretty exciting with, when you have a year like this where it's kind of choppy and there's some positive things, but there's also a lot of negative things and challenges that have to be overcome.
And right now, at the very tail end of Q2, we had a lot happened on the legislative side in Texas. And so there was something like, I think, 1,200 bills that got passed by the Texas legislature, which is amazing. A lot of those come into effect this fall or kind of late summer. And there's been a couple that are really significant. There's 3 that come to mind for me. One being the HFC bill that passed that basically completely changes the way that HFCs work. And if you're not familiar with HFCs, it's been a financing mechanism that a lot of these multifamily developers have been using to get projects done. And there was a time where you could work with a traveling, and it stands for Housing Finance Corporation, but you could work with a traveling agency. And so you could be working with an agency from like Central Texas that would be then helping you finance your project in like Denton or, some part of Dallas. Well, Texas decided that they didn't like that and the way that was set up. And so they passed a bill that basically goes and retroactively changes all that. And so you won't see now developers pursuing those in the future. And that's really significant because we had a lot of deals that clients of ours were working on, and that's how they were getting it done. And if they couldn't get it done that way, there really wasn't a way to do it. So that bill will have a pretty significant impact. It'll make it more challenging to get some projects done just from a capitalization standpoint. And then there was another bill that we're really early on in just the understanding of and just really figuring out how it will be applied. But Senate Bill 15, really just addressing lot sizes and the ability for cities to regulate just how many homes you can build on as a property, and really just saying developers can go or builders can go and they can put a lot more density on these lots. I mean, to the tune of, 20, 30 homes an acre. And so that'll be really interesting, just how that gets applied. If it is applied, what's the opposition to that? Because we've seen that in specific cities or even counties that we run into in Houston and Dallas. I know you run into it a lot in Austin, where they're like, a municipality will tell us acre lots or 2 acre lots.
Yeah, or 50 foot or 60 foot only.
Yeah.
It's like, what are we doing here?
Yeah. And so this, that bill, and then the other bill, which has a very significant impact on multifamily, which we did a podcast episode on, but Senate Bill 840, both of those bills are tied to just affordability. So if you can put more, land prices are so high, which land prices will actually go up if these bills come into play, because now you can put so much more product on the ground. But trying to provide for more affordability through more homes on less land, or through turning a lot of dilapidated commercial, a lot of dilapidated office into multifamily, into residential living. Whereas in the past, a lot of cities were just not open to rezoning properties. They were so protective of any land off these commercial corridors that was zoned office and commercial. But, things have changed so much with just how people are living and shopping and e-commerce. And so a lot of these properties are just not going to get developed. And it's really the landowners that have lost because they can't sell their properties for this use that it was zoned to. And so those bills were we're very early on. They won't even come into effect, at least on the latter two, because the HFC bill was retroactive. But these 2 Senate bills, we're already hearing a lot of buzz just with our clients. I think that'll be a lot of the story of the back half of the year, will be developers, builders pursuing deals based on just this new legislative change and seeing if it pans out. If these different municipalities are able to kind of push back and oppose them, or if there's actually a way to go, develop more density or go develop on some of these pretty incredible sites and locations.
And there was a minimum population size, right, Tom, for those, or for the multifamily one specifically?
There is, yeah. For the multifamily one, there is. And, it really doesn't apply to a lot of the smaller municipalities in our different areas. And so like for Central Texas, I think it really probably only applies to Austin and San Antonio. And
yeah, because I think it's 150,000 minimum residents, and all of our suburbs are I think the next closest one is like 131,000. So
initially I had heard that it was going to be 75,000, and then they'd increased it. Had it been 75,000, it would have gone from applying to, 20 cities across the state to a much, much larger number.
75 would have been incredible.
Yeah, that would have had a lot further impact.
Yeah, because Houston, really has pretty much no impact. I think Pasadena was the only city that qualifies, which is not a city where there's probably going to be a lot of demand. But, these cities like Clear Lake and League City and Sugar Land and Katy, some of these areas that have a lot of demand and would do very well to add more multifamily are under that hurdle. And I think we'll probably be under that hurdle for a number of years. I don't think they're going to get there anytime in the near future. So,
and it's funny, Tim, you say that about Pasadena, because technically I don't think it'll qualify because it was like 143, but it also depends on what your source is, because a lot of these cities don't have like very accurate, up-to-date population numbers, because we do our U.S. Census every 10 years. There's estimates that happen in between. So like the source we've been going to that we got from Winstead, a very active consulting group, legal group up here in DFW that's active across the state, but really doesn't have any other Houston cities other than Houston, because it has Pasadena just below. And it's interesting for those cities that are so close. Mesquite's the same way up here. It's like 146 or 147. It's like so close. And, we have a listing that would greatly benefit from this applying, but, it doesn't appear that it will. So, but I think those bills will be interesting just to see them play out. We've seen that over the last couple of years where our legislator has passed bills related to ETJs, and those have had really significant impact.
Massive impacts for Austin for sure.
And so, the response we're already seeing months before the bill takes place here in DFW, because these bills definitely impact several of our cities. It's way more than we ever saw on the ETJ front. Some developers understood ETJ, and a lot of them just never really did.
Yeah.
Some of them have done it really well. But this is one that I think it's just hard for people to pass up the ability to maybe go develop in a place like Plano or Frisco that historically would be very challenging to get approvals in.
Yeah, that's a major change for sure.
For your guys' markets, thinking about kind of back half of the year, I would say we've gotten to experience two pretty different quarters from a perception standpoint so far this year. So now back half of the year, what are you guys kind of predicting or expecting? More of the same, difference? What are you thinking?
I would say I'm pretty optimistic. I mean, I think, and I've had a lot of conversations with clients that are pretty in tune with what's going on, geopolitically and at the national level with the Trump administration and some of the different policies. But I think that there's a belief that this was going to be the toughest month in June, that there were some negative things coming out and some issues that were going to have to be figured out. With tariffs getting worked out and with even just the national economy with some of the headwinds we're facing. But a lot of that will be behind us in the fall. And looking into next year, I think that there's a lot of belief that we will see rates start to fall, if not significantly this year, then sometime next year. And so I could see the single family business maybe overreacting a little bit in the last 60 days, because we've seen that happen several times in the last couple of years where they've overreacted, they've pulled back, they've let people go, drop deals, and then next thing you know, 3 to 6 months later, they're back hiring people again, buying deals. Yeah. And so it feels maybe like kind of more of the same on the single family side. I think industrial is strong. So I think industrial is going to continue to be strong for the rest of the year. And then I think, multifamily, the fundamentals, at least in Houston, are still good. And so I think we'll keep seeing smart deals get done. I don't think we'll see a frothy market, but I think we'll see activity and, the sites that are at the right, the right kind of deal, the right pricing. One of the predictions I made in January that I still think we'll see kind of bear out this year is a return to infill development. And we're seeing some of that already. We have a deal that went under contract with hard earnest money in the Heights recently. And we have a couple developers who've reached out to us and said, hey, we have capital, for infill deals, for wrap sites, even potentially podium sites, if the pricing is right. And they can pay numbers that I think will work. We just got to find the right submarkets, and we're still having an issue in the infill market where you have some really high pricing in some of the better areas where people are holding on to, these $200 kind of numbers that really are not realistic today. But I do think we'll see more of those deals go under contract and maybe a deal or two close in the infill market, which has just been, it's been decimated in the last couple of years.
What about you, Tripp?
I'm going to say pretty optimistic myself, specifically on the multifamily front, just because we're seeing some of these positive trends start to happen. It's still really tough to get deals capitalized, and there's still a big supply issue in certain submarkets. But I think if we continue to see these really strong lease-ups, especially throughout the summer, the absorption has been incredible, and I think equity can't ignore that much longer. And so if we actually have that absorption this year, which I'm anticipating we will based on where we're trending, I think that's going to start creating some fires under these developers to go and get more deals. And we've already seen it in Q2. So the trends are just headed that way for multifamily. Single family, I think, will still be a little bit picky, especially with tariffs and rates. And I think that's going to be dependent on kind of what happens from a macro level. I think those guys are still going to go and do deals they have to make money. And Austin's a place where affordability is still pretty tough on a single family front. And so people need places to live they can afford to live. And we're still having a ton of influx of people moving to Austin, jobs or not. And so industrial, that one's going to be tricky. I'm hearing right now that it's pretty hard to get equity, especially for the bigger projects. I think it'll still be, I think it's going to be pretty particular on location and basis and size of the project. So I think that one's it's hard to tell because they're still signing a ton of leases. There's still a ton of activity, but within over the next 2 quarters, some big projects are going to break ground. And so I don't know how equity and or developers are going to react to that, but I imagine as long as these leases still happen, then these guys are going to keep building those deals.
It's amazing you have the absorption numbers you have on the multi side, which leads me to believe that, to your point, there's still people moving to Austin. There has to be, because you can't be absorbing that kind of, those kind of numbers.
Yeah, our net migration is heavily positive. So
which is great, and it's good for, it'll ultimately be good for industrial too, and just working through the supply to service just a much, much larger population than that region's ever had.
Yeah, absolutely. And then for retail, I think it's going to keep ripping. The rents that they're getting, the demand, and then the amount of multifamily and rooftops that have been built over the past even 5 years with very minimal retail development. I mean, it makes sense why we're getting all these rents, but it's like all the rooftops are there in all these submarkets with barely any retail to support it. And so I think that'll continue to remain aggressive and really active on the retail development front.
Are you seeing the grocers as active as we are up here in Dallas? Especially H-E-B has been very active, continually announcing new stores up here.
Yeah. I mean, their backyard. So yes, they're still being active, and then you're seeing other of their competitors to start to be active. Like Sprouts is really active. We've got to deal with them or they're one of the users that are under contract in a retail project we're doing, and then they're also heading out to Southwest Austin area is what I've heard. Also looking down in Kyle. So yeah, the grocers have been active, and it makes sense. There's all these rooftops, so it's like naturally these grocers are coming in full suit, and then the retail follows. So anytime there's an H-E-B, it's like, all right, if there's an H-E-B, because like the H-E-B, the last retail deal we did, there was an H-E-B up in Liberty Hill basically, and right across, and there was a ton of retail with it. And then we're putting a huge retail project next door because H-E-B brings so much traffic.
Yeah.
It's unbelievable what they've done.
Yeah, we've seen so much retail explosion and growth here too, because for the longest time there just wasn't a lot of retail development, and like you said, it was thousands of rooftops and apartments, and people were driving in some cases pretty far from like cities that had become pretty significant without any grocer, and that's totally changed the last 12 months.
Yeah. It's really interesting. Like what I was kind of tracking was that it got so hot, at least in Austin. I'm sure it was similar in Dallas and Houston, but land was so expensive and retail wasn't doing that well. And a good retail site, arguably, but like 10 to 20 acres, perfect garden site.
Yeah.
And so multi guys were just crushing them. Once that fell over, like once multi really fell off a cliff, retail guys got really hot. So it's exciting to see, and we need it. So, and we're actively doing a bunch of them. So I'm excited to see where it goes.
Yeah, that's good. I mean, I think in Dallas, I already talked about multifamily and some of these Senate bills and how that I think will have a big impact second half of the year in DFW. I think on the single family side, there's going to be just some pretty big disparity between winners and losers. I think you're going to have builders do really well that we're in the right locations that have a good basis. We're still seeing strong demand and activity in places like McKinney and Melissa, and just close to jobs, close to major thoroughfares, good areas, good schools. And then I think in some of the areas that were just more fringe or tertiary that developers and builders had not traditionally really gone to. And if they had, they just weren't developing such big communities and putting so many lots on the ground. Some of the builders that got really aggressive and took down big lot positions in some of those outlying areas, especially kind of southern parts of Dallas, which are never growing as fast, as the northern areas or parts of Fort Worth. I think that's where, there'll be pockets of builders. They're going to have to get out of some positions just because there's not going to be as much demand with the amount of supply that's out there. And I think industrial will continue to hum along. It's really strong right now, and there's not really any reason to believe that that'll change.
Yeah, I think a big question is going to be what happens with tariffs, because we're kind of like in this lull where it feels like a deal is going to get made and things are going to be okay. And that could be in the next, 30 to 60 days, or you could have things continue to be an issue, and just be prolonged, further into the year, into the fall. That's going to probably really shift things one way or another, as far as if we see equity coming back and, more demand for deals, or just more of a cautious position that groups take.
Well, guys, I think this was good. Thanks for sitting down and talking about Q2. It's interesting. I know Q1 we were much more metric focused and how we talked about it. I think Q2 it's more just some of these headlines that have been just kind of directing the market a little bit more, and everyone is paying really close attention to just news coming out. Even like you said, Tim, the thought that maybe we'll see some rate cuts, that Trump's really pushing for that, and but when's that going to happen? And just things going on with wars across the world, and just a lot of things hitting the news constantly that have everybody just kind of wondering where we're at.
Yeah, I think you could see some big shifts. So it'll be exciting to kind of keep talking throughout the year and just see where it goes.
Thank you for listening to our podcast today. If you have questions about land you own in Texas, send us an email at texaslandguys@dmre.com and follow us on LinkedIn to stay updated.